XRP is not a security, and this is just one of the game-changing rulings in the SEC's case against Ripple. At first glance, it looks like these rulings will set a precedent that will protect most crypto projects and companies. Upon closer examination, however, XRP may be the only altcoin with actual protection. Not only that, but these precedents could make it impossible for new crypto projects to emerge in the United States. So today, we're going to unpack the recent ruling and tell you exactly what it could mean for the crypto market. This is a video you do not want to miss. Let's start with a quick bit of background. The Securities and Exchange Commission, or SEC, sued Ripple Labs and two of its executives back in December 2020. The SEC alleged that the sales of XRP by Ripple and its executives constituted an unregistered securities offering, akin to basically selling stocks without registering. For context, a security is any asset that meets the 4 criteria of the Howey test. First, you invest in it using money. Second, the price action of the asset is the same for everyone who invested. Third, there is an expectation of profit. And fourth, that expectation of profit is coming from an identifiable third party. Newsflash, almost every cryptocurrency meets the first 3 criteria. It's the 4th criterion which makes or breaks the security classification. In the case of XRP, Ripple was allegedly the third party creating that expectation of profit. That's probably why Ripple's defense focused on fair notice. Put simply, the SEC didn't make it clear to Ripple & Co. that XRP was a security, nor that their sales of XRP constituted unregistered securities offerings. Now, if you've been keeping up with our coverage of the case, you'll know the SEC presented evidence that Ripple was aware of both being a possibility. This is significant because it pertains to the SEC's other cases against crypto companies and projects, namely its case against Coinbase. Many crypto companies and projects have claimed that the SEC hasn't been clear about what counts as a security as part of their defense. I'll come back to that later. Now, XRP is where things get complicated. As most XRP holders will know, the crypto project was actually created before Ripple the company existed. XRP predates Ripple by more than a year, depending on your source. Not only that, but there was never an ICO for the XRP coin. ICOs didn't even exist back then. Instead, XRP's co-founders, quote, gifted 80% of XRP's initial and maximum supply of 100 billion to Ripple when the company was created, and kept the remaining 20% for themselves. While lots of Ripple's funding has come from XRP sales, it has also sold actual shares to investors. XRP isn't Ripple stock. This is significant because conducting an ICO is one of the SEC's crackdown criteria, as is staking. XRP has neither. Instead, XRP uses a consensus mechanism that's literally called consensus, and which consists of trusted nodes that process transactions in the order they come in. XRP is not proof of stake. By contrast, almost every cryptocurrency besides Bitcoin, Litecoin, Dogecoin, and Monero has conducted an ICO, and almost every cryptocurrency coin besides BTC and its forks, LTC, Doge, and XMR, is proof of stake. In sum, XRP is different from almost every other crypto, especially when it comes to SEC-related stuff. This raises the question of why XRP was singled out, and there are many theories. Feel free to share yours in the comments. Anyhow, this brings us to the recent ruling in the SEC's case against Ripple. Now, the first thing I'll say is that the case is far from over. According to pro-crypto lawyer Jeremy Hogan, the actual trial won't happen until 2024. That's when the punishment, if any, for Ripple and its executives will be decided. The second thing I'll say is that the ruling amounts to a partial victory for both Ripple and the SEC. As noted on the first page of the ruling, the judge granted and denied different motions put forward by both parties, and only in part. It's kind of strange that some of the mainstream media has been promoting this as an SEC win. In any case, the judge begins by giving a bit of background about XRP and Ripple, which is almost identical to the one I just gave. The only difference is that the judge details Ripple's services and how much the company relies on XRP. She also puts Ripple's XRP sales between 2013 and 2020 into 3 different categories. The first is XRP sales to institutional investors, which made Ripple around $728 million. The second is XRP sales on exchanges, which made Ripple around $757 million. The third is XRP sales on the secondary market, including employee compensation, which made Ripple around $609 million. Interestingly, the judge notes that Ripple co-founder Chris Larsen and Ripple CEO Brad Garlinghouse respectively sold $450 million and $150 million of XRP using exchanges. Now, this is interesting because another Ripple co-founder, Jed McCaleb, also sold billions of XRP, and yet he was not sued. The judge then goes on to detail the marketing activities that Ripple & Co. engaged in and which allegedly led to an expectation of profit from XRP purchasers. The judge also details the legal advice that Ripple and its co-founders received about sales of XRP to investors potentially being securities offerings. She then nicely summarizes the situation in a single sentence, quote, "The question before the court is whether defendants, Ripple & Co., offered to sell or sold XRP as a security, specifically as an investment contract. Naturally, the SEC alleges that they did, and Ripple & Co. claim that they didn't. The judge then unpacks the Howey test and rejects Ripple's attempt to modify the criteria of what constitutes a security. This is significant because it means that the Howey test will remain the means by which courts will decide if cryptos are securities or not. Some have argued that this is a win for the SEC. What's fascinating is that the judge also rejects Ripple's attempts to classify XRP as a commodity like gold, silver, or sugar. This is fascinating because the judge does so on the grounds that commodities, quote, may be sold as investment contracts depending on the circumstances of those sales. She then goes on to make a groundbreaking statement, quote, XRP as a digital token is not in and of itself a contract, transaction, or scheme that embodies the Howey requirements of an investment contract. This is a big deal because it means that XRP has regulatory clarity. It is not a security. This relates to the rulings. So, the first ruling is that Ripple's sale of XRP to institutions was indeed an unregistered securities offering. The judge said this is because institutional buyers of XRP had an expectation of profit from Ripple. This means Ripple could be on the hook for $728 million. The second ruling is that Ripple's sales of XRP on exchanges did not constitute an unregistered securities offering. The judge said this is because people who were buying XRP on exchanges weren't necessarily buying because of Ripple, meaning that it didn't create an expectation of profit in this case. This is somewhat insulting if you think about it, because the judge is effectively arguing that the average retail investor isn't informed enough to be aware of the fact that XRP is a big deal precisely because of Ripple's products. Some, though, would say it's a valid point. Most retail investors just blindly buy the pump. And it's crazy to consider that some XRP holders out there don't even know Ripple exists. Regardless, the third ruling is that Ripple's sale of XRP in other secondary sales did not constitute an unregistered securities offering for the same reason that its XRP sales on exchanges didn't. This means that Ripple won't be on the hook for the additional $1.4 billion in sales it made via these avenues. As you might have guessed, the fourth ruling is that Brad and Chris's sales also did not constitute an unregistered securities offering because they sold all their XRP on exchanges. This means that neither of the two will be on the hook for their sales. It also simultaneously sanctions Jed's sales. Funny that. Now, the fifth ruling is that Ripple's fair notice defense is insufficient, at least as it pertains to Ripple's sales of XRP to institutional investors. The judge essentially explained that Ripple should have known that these sales would have constituted securities offerings considering the circumstances. And this ties into the sixth ruling, which is that neither Brad nor Chris were guilty of knowingly helping Ripple violate securities laws when it sold XRP to institutional investors. The judge explained that, based on the information Brad and Chris had regarding XRP's status, they were not knowingly breaking the law. In sum then, XRP is not in itself a security, but it's also not a commodity, which is admittedly odd. Ripple's XRP sales to institutional investors were unregistered securities offerings, and XRP sales by Ripple and its executives on exchanges and secondary markets were not unregistered securities offerings. So, it looks like Ripple will face a fine of at least $728 million as a result, while Brad and Chris will be completely off the hook. All in all, it's a good outcome, assuming the SEC doesn't try and appeal. Apparently, the SEC won't be appealing anytime soon, though it theoretically could today if it wanted. As some crypto lawyers have pointed out, an appeal is in fact possible, if not probable. That's because the judge's rulings ultimately hinge on the assumption that people who were buying XRP on exchanges or secondary markets were unaware of Ripple's involvement in XRP. Obviously, that's somewhat shaky ground. So, the SEC's appeal could argue that the average XRP buyer on exchanges did in fact know that Ripple was involved, particularly because XRP was originally referred to as Ripple and only became referred to as XRP in 2018 or 2019, depending on your source. Some people refer to XRP as Ripple to this day. Fortunately, the possibility of an SEC appeal didn't stop the crypto market from responding appropriately to the facts as they stand today. XRP exploded on the news that Ripple had clinched a partial victory, and the specific statement about XRP itself not being a security was probably the primary driver. As I mentioned earlier, this statement gave XRP regulatory clarity, which is extremely rare for specific cryptos. To put things into perspective, Bitcoin's BTC appears to be the only other cryptocurrency with regulatory clarity. XRP now having a similar status is why US exchanges didn't hesitate to relist the coin. On that note, it seems that most of XRP's initial pump came from outside the US, namely from Asia. This makes sense considering that Ripple has been focused on the region in recent years. This means it's possible that the subsequent profit-taking we saw was US XRP holders finally making some gains. Speaking of which, it's wild that XRP was deemed not a security on the same day that Coinbase had its first day in court against the SEC. As with Ripple, the SEC is alleging that Coinbase knew that it was breaking securities laws by listing certain cryptocurrencies and offering certain products such as staking. The fact that the judge in the Ripple case rejected its fair notice defense for institutional sales of XRP could make it more difficult for Coinbase to argue the same. If you watched our video about the SEC's lawsuit against Coinbase, you'll know the SEC alleges Coinbase has been breaking the law for years. On the other hand, however, the fact that XRP in itself is not a security and sales of XRP on exchanges didn't constitute securities offerings could make it easier for Coinbase to argue that it didn't offer any securities. However, the SEC made other allegations against Coinbase that it could prove in court. That's why it makes sense that ARK Invest would respond to the rally in Coinbase stock by selling shares for the first time in a year. Coinbase isn't out of the woods just yet. Then again, these sales could be because the ARK ETF has fallen out of favor. Investors have reportedly pulled over $700 million out over the last year. It's a similar story for the other crypto projects that have received SEC scrutiny, namely ADA, Sol, and Matic. All three of these cryptos went parabolic on the assumption that the ruling in the Ripple case would protect them as well. However, you'll recall that XRP is radically different from any of these three cryptocurrencies. If you watched our video about the SEC's lawsuit against Binance, you'll know why the SEC believes ADA, Sol, and Matic are securities, and that these criteria are different from those it laid out for XRP. This could be a sign that none of these three cryptos are in the clear, but it's honestly hard to say. As time goes on, uncertainty is becoming the biggest takeaway from this ruling, and it doesn't help that it's very technical. For example, one lawyer who wrote for Cointelegraph noted that the ruling, quote, does not set a precedent. Instead, it may only serve as persuasive commentary, whatever that means. Similarly, CoinDesk underscored the fact that, quote, the expectation of profit prong doesn't require an expectation of profit as a result of the efforts of the seller, but rather the efforts of another. As will be obvious to anyone active in the industry, XRP's principal promoter is and always has been Ripple Labs, whether a purchaser was aware they were purchasing tokens from Ripple Labs or not. In response to this uncertainty, pro-crypto politicians have been tabling pro-crypto regulation, which is certainly good news. The bad news is that this pro-crypto regulation may not get voted on until after the next US election. Until then, crypto projects could have a hard time getting off the ground in the United States. Now, if you're confused, consider the implications of the first ruling. OTC sales to institutional investors are not allowed. In practical terms, this means that crypto projects won't be allowed to sell coins or tokens to venture capitalists. They will only be allowed to sell coins or tokens via exchanges or on secondary markets. Now, in theory, this is a good thing because it means there won't be any VC dumping with newer crypto projects coming out of the US. In practice, however, this is a bad thing because it means that these newer crypto projects are less likely to get VC funding at all, meaning they may never emerge to begin with. This could also have a profound impact on existing crypto projects based in the US. No more VC selling means no more VC dumping, but it also means that crypto projects that already sold to VCs could be at high risk of a crackdown from the SEC, and the ones that sold the most to VCs will be the hardest hit, not naming names, of course. Now, the silver lining is that this precedent, assuming it holds, is extremely good news for exchanges. Again, that's because it means that all crypto trades on exchanges are fair game. As pointed out by crypto analyst Adam Cochran, this will inevitably force all OTC selling to flow through exchanges. The result could be record profits for exchanges during the next bull market, which translates into more lobbying to get pro-crypto regulations passed. Again, this assumes that the SEC won't nuke these exchanges with other allegations. Unfortunately, offering securities via trading is just one of many. As for Ripple, meanwhile, it's too soon to say how this ruling will impact its operations. Some have argued that losing over $700 million will do serious damage to the company. Others have argued that Ripple has more than enough capital on hand to pay these bills, as it sold lots of XRP during the recent bull market. If this precedent does hold, though, then it should give a huge boost to Ripple's actual business. This could set the stage for Ripple going public, i.e. listing its stock on a stock exchange. Brad had mentioned last year that Ripple would explore an IPO after the SEC lawsuit is over. Some would say it's almost there. The only caveat is that Ripple is no longer the only competitor in the payment space. 3 years is a long time in crypto, and it could be 4 years by the time the case is actually resolved. By then, there could be dozens of cryptos offering the same products and services as Ripple, without a centralized company. Stellar is the elephant in the room in this regard, and it has already managed to take away some of Ripple's top clientele, MoneyGram being a memorable example. So, Ripple is going to have to find some way to reinvent XRP considering all this new competition, and that will be easier said than done. For what it's worth, though, XRP has one of the largest communities in all of crypto. Now that XRP is not a security, that community will come back stronger than ever. This could be enough to get XRP back on track and turn it into the disruptive payments network it was destined to become. Let's just hope the SEC doesn't appeal. And that's all for today's video, folks. If you found it insightful, let me know by smashing that like button. If you want to get more insights, subscribe to the channel and ping that notification bell. And if you want to help others get these insights, take a second to share the video too. If you happen to be an XRP hodler, make sure you're keeping your drops safe by using a hardware wallet and acquiring your non-security status XRP on a trustworthy exchange. The Coin Bureau deals page has huge discounts on the former and up to 40 grand of airdrops and bonuses on the latter. The link is in the description. Thank you all for watching, and I'll see you next time. This is Guy, over and out.